5 days, that's the window. In just 5 days, the US government faces another potential shutdown. And if it happens, the impact won't be limited to politics or headlines. Something deeper inside the financial system will come under pressure. Something most people won't notice until after it matters. But by the end of this, you'll understand exactly what's at risk and why the timing matters. To understand what could unfold, it helps to look at what happened the last time the government shut down for an extended period. When funding lapsed, uncertainty surged across markets. Precious metals reacted immediately. Gold pushed into new highs. Silver moved sharply, breaking through multiple resistance levels in a matter of weeks. And when the shutdown finally ended, something unexpected happened. Prices didn't reverse. They continued higher. That move wasn't about politics. The shutdown itself wasn't the cause. It was the catalyst. It exposed stresses that were already present beneath the surface. Those same pressures haven't gone away. In fact, they've continued to build. And now, with another deadline approaching, the conditions look even more fragile. In the coming minutes, I'm going to explain why silver, in particular, could be approaching a moment that catches most people off guard. I'll walk you through 4 risks that are rarely discussed and why their convergence matters. This isn't about headlines, it's about structure. January 30th, 2026. That's the current funding deadline for much of the federal government. Some measures have moved through the House, others still face uncertainty. There are only days left to resolve it. Will lawmakers reach an agreement? Possibly, but here's what many overlook. Whether a shutdown is officially avoided or not may be less important than the damage already done. The setup is already in place. The pressure is already building. Right now, 4 separate forces are converging. Each one on its own would be supportive for silver. Together, they form a setup that deserves attention. Let's start with the first. Threat 1, the data blackout. When government operations pause, something critical often goes unnoticed. The flow of economic data slows or stops. Key reports on inflation, employment, and growth are delayed. Agencies responsible for collecting and publishing this information go quiet. The result is a sudden lack of visibility. Central banks rely on this data to guide policy decisions. Markets rely on it to price risk. Trading systems and risk models are built around it. When that information disappears, decision-making becomes guesswork. During the last extended shutdown, weeks passed with limited insight into what was actually happening inside the economy. When the data finally returned, it revealed conditions that were weaker than markets had assumed. Confidence dropped quickly because the market had been operating without a clear picture. This matters for silver because uncertainty changes behavior. When reliable information disappears, volatility rises, risk models lose precision, and capital tends to move toward assets that don't rely on government reporting to maintain value. Historically, periods of elevated volatility have produced some of silver's fastest and most aggressive moves, not over months, over days. That was the first risk, the loss of visibility. Next comes a second pressure point, one that sits at the core of the financial system itself. Threat 2, collateral stress. The United States is carrying an unprecedented level of debt. Interest costs alone now rival the largest categories of government spending. When political dysfunction becomes visible, credit markets take notice. Rating agencies reassess risk. Questions emerge. Not about short-term payments, but about long-term credibility and governance. U.S. Treasury securities sit at the center of the global financial system. They are used as collateral in banking, funding, and derivatives markets. If confidence in that collateral weakens, even slightly, the effects ripple outward. Margin requirements rise, funding costs increase, liquidity tightens. We've seen versions of this before, When collateral confidence is shaken, markets can seize unexpectedly, forcing emergency responses. In those moments, the initial reaction is often stress and forced selling, but once the dust settles, attention shifts toward assets without counterparty risk. Physical assets, tangible stores of value. Silver has historically responded strongly in the aftermath of liquidity shocks, not because it's immune to volatility, but because it exists outside the credit system. That brings us to the next layer of risk, one that's already developing even before any official shutdown begins. At its peak, this facility held more than $2 trillion, trillions in excess liquidity sitting on the sidelines, acting as a buffer for the financial system. That buffer is now largely gone, drained down to a fraction of what it once was. And that matters because this pool of liquidity served as the shock absorber. When stress hit, that cash could flow back into markets and stabilize funding. Today, that cushion is no longer there. At the same time, the Federal Reserve continues to reduce liquidity. Balance sheets are still being trimmed. Monetary conditions are still tightening. So now consider the full picture. A potential government shutdown, renewed scrutiny on U.S. debt credibility, a depleted liquidity buffer, and ongoing tightening from the central bank. That combination increases the risk of a funding squeeze. If dealers begin to hold onto cash, if banks pull back from lending, or if repo markets experience stress, funding rates can rise quickly. We've seen this before. In late 2019 and again in early 2020, stress in overnight markets forced emergency intervention. One of the indicators professionals watch closely during these moments is the spread between key overnight funding rates. When that spread widens, it signals rising demand for cash and strain beneath the surface. Reports already suggest that this pressure is beginning to build. The system is showing signs of stress even before any shutdown officially begins. So what tends to happen to silver during a liquidity squeeze? Initially, almost everything comes under pressure. In moments of panic, investors sell what they can to raise cash. Silver is no exception, but that phase rarely lasts. What follows is usually a policy response. Liquidity injections, rate cuts, balance sheet expansion. And when that wave of liquidity enters the system, silver has historically responded forcefully. That dynamic defines the third risk, a liquidity freeze followed by intervention. Now consider the fourth factor, recession risk. Each week of government disruption subtracts measurable growth from the economy. On its own, that impact may seem manageable, but the broader context matters. Manufacturing activity has been slowing. Consumer confidence has weakened. Yield curves have shown stress signals. The economy is already vulnerable to additional shocks. In that environment, even a short disruption can amplify existing weakness. A longer disruption increases the odds that slowing growth tips into an official downturn. Historically, recessions create mixed short-term reactions for silver due to its industrial demand. But over medium time frames, recessions have tended to favor precious metals. Why? Because economic contractions force policy responses. Rates are lowered. Liquidity is expanded. Fiscal spending increases. And those actions place pressure on currency value. In previous downturns, silver initially dipped, then advanced sharply as policy responses took hold. The pattern has repeated more than once. So now step back and look at the full setup. Reduced data visibility, collateral sensitivity, liquidity stress, rising recession risk. Each factor alone would be noteworthy. Together, they create a rare convergence. This is why silver is drawing attention, not simply because of price action, but because of structure. Supply dynamics have tightened. Physical availability has diverged from paper pricing in certain regions. Strategic considerations have increased. These conditions existed before any shutdown discussion. A disruption simply acts as an accelerant. History shows that funding stress often unfolds in stages. First comes uncertainty, then tightening liquidity, then policy response, and finally, asset repricing. Silver's largest historical moves have tended to occur during the transition between those stages. One more indicator worth watching is stress in short-term funding markets. When borrowing costs rise unexpectedly relative to policy rates, it signals imbalance. In past episodes, widening spreads preceded intervention. Observers are beginning to note early movement again. It doesn't guarantee outcomes, but it does signal attention is warranted. At this point, it's important to avoid extremes. Moving entirely to cash can feel safe during uncertainty, but cash itself is a promise tied to policy credibility. Precious metals are different in that they don't rely on ongoing institutional performance. That distinction is why they are often revisited during periods of stress. This is not a call to act recklessly or abandon balance. It's a reminder to understand positioning, risks, and timing. The days ahead may bring volatility, the weeks ahead could bring clarity, and the months ahead may reflect consequences of decisions already made. What matters now is awareness, watching negotiations, monitoring funding conditions, observing volatility indicators, listening closely to policy language. These signals often move before headlines do. Periods like this rarely provide clean signals or comfortable entry points. They test patience and discipline, and they reward preparation over reaction. Any signal that the Federal Reserve is growing uneasy about liquidity matters. Any acknowledgement of funding stress, any hint of potential intervention. Historically, those moments have acted as powerful catalysts for precious metals. This is why physical premiums matter so much. When the gap between paper pricing and real-world silver keeps widening, it suggests the physical market is responding to pressures the paper market hasn't fully priced in yet. China is another key variable to watch. Any additional export restrictions, any signs of increased stockpiling or tighter controls can have global ripple effects on supply. These are not abstract risks. They directly impact availability. Now let me be clear about what follows. This is analysis, not advice. Everyone should evaluate their own situation carefully. Based on current conditions, volatility appears likely to increase over the coming weeks, regardless of whether a shutdown occurs. Uncertainty alone has a way of moving markets. The Federal Reserve is likely monitoring funding conditions closely. They have strong incentives to avoid a repeat of past funding disruptions. If stress builds, some form of response becomes increasingly likely. The only open questions are timing and scale. Silver, structurally, remains one of the most sensitive assets to these dynamics. Supply constraints, strategic importance, and physical market behavior all point in the same general direction. Over time, paper pricing has tended to converge with physical reality. Whether that adjustment comes through price appreciation or normalization elsewhere is uncertain. But history suggests the paper market usually adjusts upward. What we are seeing is not just a short-term reaction. It reflects broader shifts already underway. A gradual move away from purely paper-based assets. A renewed interest in tangible stores of value. A reassessment of trust in long-standing financial promises. During the last major shutdown, consumer confidence fell to levels lower than those seen during previous crises. Lower than during the financial crisis. Lower than during the pandemic. That erosion of confidence matters. When trust weakens, behavior changes. People begin looking for assets that have endured through uncertainty for centuries. This is why precious metals are often viewed not just as trades, but as long-term hedges. Not against markets alone, but against institutional fragility. History reinforces this pattern. During the extended shutdown several years ago, gold posted modest gains during the event itself. But the larger move came afterward. The shutdown exposed vulnerabilities. It raised questions about governance and credit reliability. Those concerns lingered long after the headlines faded, fueling a sustained advance. More recently, similar behavior appeared again. Short-term relief rallies were followed by renewed strength. The disruption was not the event. It was the signal. There is also a lesser-known effect of shutdowns that often goes unnoticed. Government cash management becomes constrained. Treasury balances are drawn down. When normal operations resume, rebuilding those balances often requires increased issuance. That can tighten funding conditions further, even after the shutdown officially ends. The stress doesn't vanish overnight. It echoes. Then there are moments that never make front-page news. Quiet liquidity injections, emergency facilities accessed without immediate disclosure. When these actions occur, they signal pressure somewhere in the system. The details often emerge much later, but the existence of intervention itself is revealing. Silver occupies a unique position in all of this. It is both a monetary asset and a critical industrial input. That dual role creates powerful dynamics. In economic slowdowns, some industrial demand may soften. At the same time, investment demand often accelerates. Historically, the investment side has tended to dominate. What makes this cycle different is the nature of modern industrial demand. Much of it is structural. Solar energy, electrification, advanced electronics, medical applications. These uses are not easily substituted or deferred. Even during economic slowdowns, many of these projects continue. This means silver faces a rare situation where investment demand and essential industrial demand can remain strong at the same time. Another metric worth attention is the gold-to-silver ratio. Historically, during precious metal bull markets, this ratio compresses. When fear rises and demand accelerates, silver has often outperformed gold on a percentage basis. If that pattern repeats, even modest ratio compression implies significant relative movement. Ultimately, the next few days will bring clarity on immediate political outcomes. But the deeper forces at work extend far beyond a single deadline. Debt levels, liquidity pressures, supply constraints, trust dynamics. Silver is not influenced by political theater. It responds to fundamentals. And right now, those fundamentals suggest rising tension between demand and available supply. Whether the current moment acts as a wake-up call or simply another warning depends on how events unfold. History suggests these pressures don't disappear. They build. They pause, and eventually they resolve through repricing. If this analysis was useful, consider sharing it with others who are paying attention. Stay informed. Watch the signals. Volatility tends to reveal more truth than calm markets ever do. I'll continue monitoring developments closely. When something meaningful shifts, I'll break it down here. Stay alert. Stay grounded. The next phase is approaching.